Market Prospects, delivering timely information and education to prairie farmers for 30 years. Market Prospects is brought to you by the University of Saskatchewan's Department of Bioresource Policy, Business and Economics, and these sponsors. Log on to marketprospects.usask.ca to view past programs and for information on upcoming programs.
This week in our Market Prospects interview, we zero in on the canola situation and outlook. Joining us from Winnipeg is Dr. Derek Brewin, Associate Professor, Department of Agribusiness and Agricultural Economics at the University of Manitoba. Dr. Brewin, it's great to have you on Farmgate.
Nice to be here. Thanks, Bob.
Well, let's begin with your assessment of the canola markets and what we can expect for movement, prices, and ending stocks as we approach the end of the current crop year.
Well, the buildup so far this crop year has been depressing in terms of price. We've seen an increase in ending stocks worldwide for the oilseeds and grains and oilseeds together. And then we saw a big soybean crop in the United States. So that's all been bearish for price. On the positive side, the Canadian dollar has dampened some of that effect to the Canadian producer, and we've seen some improvement in our transportation basis. So if we look at export prices, they're actually down $80 a ton US, but I look at prices here in Winnipeg, they're pretty flat from last year, and that's because of the dollar's movement down and improvements in our export basis.
So what key factors are currently affecting price and basis in canola markets, and what issues should we watch for in the 2015-2016 crop year?
The overall S&Ds are always important. You can check things like that with USDA reports as they're coming out. A good share of the world's crop is grown at the same time as us, so the growing conditions through our summer are important for the overall price structure. I think production concerns could cause a price spike, but we could also see higher than expected production here again in Canada, perhaps hurt our export basis, go back to some problems in our export basis. I think one of the important things is getting good price information. There's good information from the USDA on S&Ds, and they have pretty good port price series, and Ag Canada is starting to put out some port prices, but whether or not that port price gets reflected back to farmers depends on how well our transportation and handling system is working. Quorum Corporation's put out some details on that, and it's looking like our export base is going back to the levels it was before that 2013 crop. The crushers are also putting out some pretty good information on their websites. The Bunge crushing plant in Altona right now has pretty good prices for fall delivery. They're at the top of my trading range. So all that information is important for the farmer to follow.
So what is your canola price and acreage projection for the coming year on the prairies? And should farmers be locking in prices on basis as well as basis for the upcoming crop year?
Well, I think on the area side, I think that prices here are pretty good compared to, and actually maybe better than they were last year against wheat. So I don't see us losing area to wheat. Some people in the trade are talking about us possibly losing area to soybeans, but that's a small overall crop. And if I look at the overall, or the price of soybeans here in Winnipeg, the price of soybeans down versus last year, while canola prices are up. So I don't think we do lose area to those crops. So the Ag Canada forecast for area is for up slightly, and I would agree with that as long as we don't have disease concerns or a price fall off before seeding. On the overall prices, I would say following medium-term trading ranges, I think a price below $8.50 a bushel or above $12.50 a bushel is unlikely this year. I don't think there's a possibility of a price spike if we see production problems in the U.S. soybean crop, but that's a rarer event than just having average production. And I think there is a possibility we have a higher than expected crop here in Canada and increase the basis, so we've got some downward movement too if our transportation problems return. But I think we trade at the bottom of that range around $9.50 to $10.50. I think the summer concerns would be the problem. On the downside, I think growing conditions and concerns about having enough production could be a positive impact.
So how are crushing margins comparing this year to last year then?
The crushing margins this year are actually still pretty good. They're $90 a ton at ICE. If you look at the soybean oil and meal prices converted into Canadian dollars and compare them against the canola price, that crushing margin now is $90 a ton. And at $20 a ton, we were still getting a pretty healthy crush pace. So I think that this is pretty good. It's not as good as it was last year. It was $200 a ton. But it's still pretty profitable. So I think our crushing pace probably stays pretty good.
Well, thank you, Dr. Brewin, for your insights on canola. Thank you very much.
You're welcome. Pleasure to come on here.
We return right after a brief commercial break. Please stay with us.